Welcome to our third quarter market update from John Giordani, the Chief Investment Officer at Planning Solutions Group. So far, this year's markets have been relatively calm despite the dysfunction of our elected officials in D.C. We have spent a lot of time in previous updates discussing politics and the markets. Today, we are going to focus more on fundamentals. Let's start with the good news in the economy. Across the globe, we are seeing growth. Shown here is manufacturing data. Look to the far right. For the first time in years, all major economies are expanding. The term global synchronous recovery is in vogue with the economists. The financial crisis from 2008 is in the rearview mirror. Even Europe and Japan appear to be getting their houses in order and are returning to growth. Here in the U.S., it has been one of the longest recoveries on record, but also one of the weakest. Weak recoveries are common after financial crises, as we have previously discussed. Absent a shock, a recession does not appear to be in the cards this year. More good news comes from the earnings front. Just as global economic growth is occurring, so too are we seeing a rebound in earnings. Shown here is earnings growth for the U.S., developed international markets like Japan and Europe, and emerging markets like Asia. One of our key worries last year was that corporate earnings were in a recession and that unless growth resumed, stock prices were likely too high. This looks like a ghost of Christmas past as well. Oil prices have rebounded, which are helping the bottom lines of energy companies. And finally, overseas companies are seeing the light at the end of the tunnel. In fact, international earnings are looking much stronger versus what U.S. companies are experiencing. International stock markets have been in the doldrums for the past several years due to lack of earnings growth and other fears. More to come on international stocks later. The good news has translated into gains for U.S. and international stock markets this year. Looking at the chart and moving from left to right, at the halfway point, major stock market indices both in the U.S. and overseas are registering high single-digit gains or more. Like the earnings story, for the first time in years, international stocks are leading the pack as they are handily outperforming U.S. stocks. Bonds, which are the shock absorbers for investors' portfolios, are also positive year to date. After a very strong 2016, commodities are giving back a big chunk of those gains as this asset class is down almost 10% year to date. Let's take a look at a specific sector, U.S. banks. Usually we don't drill down on a sector, but I thought the news here was significant. Developments bode well for the sector and are positive for both financial stocks and preferred securities. Near the end of the second quarter, we received news that for the first time, every one of the U.S.'s largest lenders passed the annual stress test. The stress test was initiated after the great financial crisis in 2008 to prevent another bout of financial Armageddon. Banks must have enough capital to withstand negative shocks, such as significant drops in house prices, high unemployment, or stock market losses. The balance sheets are healthier than they have been in years. On the back of this news, the Fed gave the banks the green light to begin rewarding shareholders. The companies announced massive increases in share buybacks. This is shown on the chart to the right from Bloomberg. These 5 banks listed here have plans to buy back over $60 billion in company stock during the next 12 months. In addition, each bank hiked their dividends to give shareholders a pay raise. This is shown on the top chart to the right. The 2 largest hikes were from Citigroup and Bank of America, which increased dividends 100% and 60% respectively. Many of you have seen this chart before, but given earlier comments, it is important to revisit this topic. The chart looks at relative performance of U.S. stocks versus international stocks. Periods in orange are where U.S. stocks are doing better than international stocks. Conversely, periods in blue are those where international stocks are doing better than U.S. stocks. At the top, the magnitude of outperformance is listed. Some takeaways. Asset classes perform differently over various time periods. Over the past 45 years, U.S. stocks have led in 4 of these periods, while international have led in 3. But guess what? Over the entire data set, total performance between the two asset classes is not that different. If you have a long-term horizon, you will need to own both since market timing does not work and it is hard to predict when one will begin to outperform the other. Now let's zero in on the past 9 years. U.S. stocks have bested international stocks by a huge margin, 97%. In addition, it has been one of the longest periods of outperformance. Such an occurrence has led asset manager GMO to label this period as extreme. Given our discussion earlier where both economic growth and earnings growth are coming in stronger overseas than here in the U.S., now may be the time for the baton to be passed. I would not be surprised to see international markets outperform going forward. So far, it has been a pretty Pollyannish presentation. Let's switch gears and talk about a few of my worries. Valuations are high for most asset classes. A lot of that good news that I talked about earlier is likely reflected in stock prices, especially here in the United States. This table highlights the valuations for U.S. and international stock markets. It is broken down by percentile. Moving along the right, the more expensive the asset class is to its historical valuations during the past 20 years. U.S. stocks are in the most expensive quartile. This means that on average, over 70% of the time, they have been less expensive than they are now. International stocks in Europe, Japan, and EM or emerging markets are cheaper than U.S. stocks on a relative basis. If you like to buy items on sale, this may be another reason that international stocks outperform going forward as valuations play catch-up to those here in the U.S. This does not mean it is time to exit and sell your U.S. stocks. Valuations are not a good predictor of short-term price movements. However, they are a very good predictor of future returns 7 to 10 years out. Historically, when U.S. stocks have been this expensive, returns have been below average. The message here is to lower your return expectations for this asset class going forward. Since our last presentation, the Fed decided to raise short-term interest rates again. It is now the fourth interest rate hike since late 2015. Investors were also given the playbook to how the Fed plans to shrink its balance sheet. Shown here are the assets held by the Federal Reserve. Notice that in 2008, its balance sheet began to rapidly expand as it bought assets to support the economy after the financial crisis. Unwinding this balance sheet removes the liquidity from the system. Risks increase as each meeting not only will investors have to debate a potential rate hike, but also whether the Fed will move to implement the plan to shrink its balance sheet. The bulls will point to a healthy U.S. economy, recovering global economies, and removal of political risks as reason to act now to continue to raise rates and reduce the balance sheet. The bearish stance will be that the expansion of the Fed's balance sheet did little for the economy, but instead simply inflated asset prices. As they unwind the balance sheet, asset prices, including investors' portfolios, will deflate. My take is that the Fed is walking a tightrope. If they tighten financial conditions too quickly, the U.S. economy risks entering a recession. However, if they continue down the path they have been on, they are sowing the seeds for another bubble. I expect plenty of hand-holding and guidance from central bankers going forward. They continue to hand out the answers to the test before the test date. Bottom line, expect volatility to increase if the Fed continues to move forward with more tightening actions. Some other risks include geopolitical risks. While elections in Europe this year turned out to be benign, North Korea is still a big issue confronting investors. Another one is U.S. policy failure. So far, not one major initiative has been enacted as promised by the new administration. Investors want to see fiscal stimulus, including tax reform or infrastructure plan, put into place. Now, where does that leave us? We are more cautious than several years ago. Given where we are in the cycle and the run that U.S. stocks have had, having a diversified portfolio is important. Owning blue chip type companies that have high quality balance sheets makes more sense than speculative ones. And playing a little more defense doesn't hurt. Having defensive assets gives an investor a piggy bank to take advantage as opportunities become present. For bonds, emphasize flexibility and diligence to protect against both interest rate risk and credit risk. This wraps up our current market update. If you have any questions, contact us. You may also access more information, including timely articles and account information, by visiting our homepage. Please watch for another market update later this year. Thank you.